and that would have been frustrating to me. So I placed the small trade, observed the pattern in real time, made a small profit, and started the process of integrating the pattern in my usual trading. In selecting trade size, I was letting my psychological resilience dictate my risk-taking. When I traded to my resilience level, I kept myself in a favorable state, regardless of the trade's outcome. How will I feel if I'm stopped out dictated my trading size? To be sure, this can be taken to an unhealthy, risk-averse extreme. We can take so little risk on trades that we severely diminish potential returns. The key is to know yourself and especially the limits of your resilience. Occasionally I'll fantasize about placing an Uber trade on a promising idea and taking a mammoth profit. I realize, however, that such a trade can overwhelm my resilience. As soon as the position went against me, even in a normal, expectable, adverse excursion, I would be stressing about the dollars lost. Undoubtedly, this would prevent me from managing the trade effectively. Successful traders learn to build their resilience over time and adapt to stresses that at one time might have been overwhelming. That small trade I recently placed would have qualified as a large trade back in the late 1970s when I placed my first trades. Now it is emotionally inconsequential. Experience builds adaptation. We can generally handle familiar situations with a high degree of resilience. When we master one level of challenge, we build resilience for the next level. The most effective way to build emotional resilience is to undergo repeated, normal drawdowns and see, in your own experience, that you can overcome those. Our losses provide us with the deep emotional conviction that we can weather losses and ultimately prosper. Someone who has undergone many life setbacks and bounced back acquires the confidence that he can land on his feet in almost any situation. The trader who experiences repeated drawdown, only to later hit fresh equity highs, knows that she has nothing to fear during normal performance pullbacks. When you are your own trading coach, your challenge is not only to sustain a high level of resilience, but also to build that resilience over time. A worthwhile exercise is to expand on the routine from my recent trade and vividly visualize the worst-case scenarios for trades that you place. In other words, once you set your stop level, visualize how you would feel and how you would respond in that worst-case scenario. Most importantly, figure out what your next course of action might be, including your possible next trade. In other words, mentally rehearse the resilient behavior that you want to cultivate. You can think of this as play-acting the role of a highly resilient person. As you rehearse resilience and act on the rehearsal, that role becomes more a part of you. To paraphrase Nietzsche, you're finding your greatness by play-acting your ideal. In trading, we develop ourselves. Every gain is an opportunity to overcome greed and overconfidence. Every loss is an opportunity to build resilience. Beware! Resiliency does not mean that you jump into subsequent trades after you sustain losing ones. Rather, the resilient trader is one who can sustain well-being even after normal, expectable losing trades. When you lack resilience, you become backward-looking and respond to the last trade rather than the next market development. The resilient trader remains proactive even in the face of loss. A resilient trader might thus stop trading or resume trading following a loss. It's the following of basic, time-tested plans and strategies, and not impulsively running toward or away from risk, that defines authentic resilience. Coaching cue. If I ask a trader how well he is doing and I receive a dollar figure as a reply, I usually know there's a problem afoot. Experienced traders think of their returns in percentage terms, not absolute dollars. Thus, for example, they might think of cutting their risk if they're down 5% on the year, or limit their risk on a trade to 25 basis points, 0.25% of their portfolio value. If you calibrate yourself in dollar terms, you will find it difficult to increase your trading size or to get larger as you grow your portfolio. Standardize your view in percentage terms, and you make yourself more resilient. A $20,000 loss on a $2 million portfolio won't feel significantly different from a $500 loss on a $50,000 portfolio. Similarly, when you cut your trading size, you'll standardize your risk management if you're calibrated by percentages rather than let losses run because they seem small in absolute dollar terms. Lesson 28. Integrity and doing the right thing. Many of the lessons in this book begin with a discussion of a trading issue and then proceed to suggestions about what you can do about the issue. This lesson will actually start with the recommendation and then work backward from there. Your assignment is to read Ayn Rand's novel, The Fountainhead. If you've read it previously, the assignment is to reread and review it. For those not familiar with the book, The Fountainhead is the story of architect Howard Rourke, who is an unorthodox creative genius. He faces stiff opposition to his ideas, including the ambivalence of the woman he loves. Throughout, he must decide whether to abandon or compromise his ideals, especially as he sees lesser talents succeed commercially by pandering to public fashion. In many ways, The Fountainhead is a study in integrity and the difficulty and importance of doing the right thing. There can be no self-esteem without a self, a well-defined sense of who one is and what one stands for. There are many false substitutes for self-esteem, including the approval of others and the size of one's trading account. Ultimately, however, self-esteem is a function of knowing yourself and remaining true to your values, possessing a vision of what can be, and remaining faithful to that vision. Many traders have no more vision than a desire to make money. There's nothing wrong with making money, of course, and for those who do so through the independent efforts of mind, such earnings are a rightful source of pride. Traders who attempt to latch onto holy grails instead of independently relying on their planning and judgment, however, substitute the desire for a quick, easy score for the more difficult challenge of developing competency in reading and acting on market patterns. Someone who consummates a long-term courtship and someone who hooks up for a one-night stand engage in the same physical act, but the meaning is completely different. One is an expression of esteem. The other is often a flight from self. In so many fields, we never see the fruits of our labors. We're part of a larger team and process. Trading is unique in that we alone are responsible for what we earn, and we see each day the outcomes of our efforts. When you read The Fountainhead, it's instructive to reflect on how Howard Rourke would approach the field of trading. Would he join a proprietary trading firm that frantically searches for stocks in play, robotically fading moves, or chasing strength or weakness? The mere thought is ludicrous. He worked from blueprints that he had developed from scratch. In short, Rourke would approach trading the same way he approached architecture, as an expression of his creative vision and the sheer joy of giving birth to something new and valuable. Most of all, Rourke the trader, like the architect Rourke, would stand for something. He would have a view of following the crowd versus act on his convictions. He wouldn't hesitate to do the right thing. Every great trader I have known has an outlook and a set of methods that are distinctively his own. For that reason, economic success for trader Rourke would be a tangible indicator of his efficacy and the rightness of his efforts. It is effect, not cause. He doesn't trade to simply make money any more than he builds to sell homes and office buildings. Rourke the architect built because that was what he was meant to do. Even when he didn't have clients, he was designing buildings in his mind and in his sketches. Similarly, trader Rourke would be tracking and investigating markets even if he wasn't placing orders. His work is an extension of who he is. His profits are the result of years of effort and integrity. One's work could entail raising a child, building a business, designing a high-rise structure, or developing a unique framework for analyzing and trading financial markets. Each, to be accomplished well, requires sustained, dedicated effort, a vision of what can be, and a willingness to pursue that vision even when it's more comfortable to slide by. This is the true source of emotional resilience, a pride and esteem so deep that one is unwilling to compromise oneself in the face of setbacks and disappointments. What about your trading is uniquely yours? What have you developed that most distinctly distinguishes you as a trader? What is the vision behind your trading? That is your core, your essence as a trader. When you're trading well, you're remaining true to that essence, and that will serve you well during the most challenging times. If you can't provide detailed answers to these questions, are you truly ready to be risking your capital? Will you really have the confidence to weather adversity with only borrowed ideas and methods to draw upon? Read Chapter 9 of this book carefully. You'll see that experienced traders build a career from their work, from figuring markets out for themselves, and then remaining true to their ideas and to the evidence of their senses. Coaching cue. This lesson shows why it is so important to follow one's trading plans. The plans may not be perfect, and they may not work well at times. If, however, you are to build confidence in your judgment and train yourself to act with integrity, there's no alternative to following the ideas you believe to be correct. You cannot build confidence by abandoning your convictions and contradicting your perceptions. The clearer you are about your market views, mapping out your actions under various scenarios, and your rationales for trades, the easier it will be to act on your judgment and see, in your own experience, your own progress and growth. Lesson 29. Maximize confidence and stay with your trades. A great deal has been written about risk management and the importance of stop losses. A stop loss, ideally, is that point that tells you that your initial trade idea is wrong. Traders establish firm stops that are closer to the point of entry than the price targets and help ensure a favorable risk-reward profile to each trade. You can generally tell a professional trader by the way she closes out a losing trade. The exit is automatic, not a cause for consternation. Loss is an accepted part of the game. The good traders learn from those losses and use them to revise market views. A losing trade, as a result, can set up the next winning trade. Much harder for many traders, and far less remarked upon, is something we might call stop profits. Traders who religiously adhere to stop losses can find it difficult to let profits run on winning trades. They stop those profits out prematurely, reducing the reward portion of the risk-reward profile. Over time, these traders have trouble succeeding because their winning trades end up being not much larger than their losers, and sometimes smaller. There are a few reasons that traders tend to cut profits short. One reason is that they fail to identify profit targets as clearly as stop-loss points. Such targets may be based on a number of factors, such as the market's overall volatility, the presence of distinct support and resistance levels, and the time frame of the pattern being traded. Many of my trades, for example, are based on historical analyses of the probability of hitting particular price levels, previous day's high or low, pivot point levels based on the prior day's high-low close. Those levels then serve as targets for setups. It is much easier to stick with a trade when there is a firm target in mind, just as it's easier to get work done when you have a clear goal in mind. Without a predefined target, it's easy to get caught up in the tick-by-tick ups and downs of the market, acting on fear and greed unrelated to the initial trade idea. Another culprit in those stop-profit scenarios is a lack of confidence in one's trade ideas. One of the important advantages of testing one's trading setups is that you can estimate the historical odds of a market acting in your favor. That knowledge can provide the security necessary to see the trade through to its ultimate target. When trade setups and patterns are borrowed from others without prior testing, either through one's own paper trading or through historical analysis, it is difficult to have a deep inner sense of confidence in the ideas. As markets experience normal retracements on the way to a profit target, those adverse excursions become difficult to weather. Instead of seeing them as potential opportunities to add to the trade at good prices, it's easy to perceive them as threats to paper profits. Finally, a trader's risk aversion may play a role in prematurely stopping out profits. Suppose you have a choice between taking a sure $1,000 profit versus a 75% chance at $1,500 and a 25% chance at $500. Over time, taking the 75% chance will make you more money. Nonetheless, at any given point in time, a person may feel that it's foolish to walk away from a sure $1,000. In such a situation, the decision is made as much for the trader's peace of mind as for overall profitability. Similarly, traders may set stop profit levels to achieve a sense of certainty, not to maximize returns. Seeing a trade through to its target requires an unusual degree of security and ability to tolerate uncertainty. As the trade moves further in your favor, you have more money in paper profits that you're exposing to future risk, even if the risk-reward picture remains favorable. This ability to sit through a trade's uncertainty as profits accumulate requires particular confidence in the initial trade plan. Ironically, it takes more confidence to stay in the trade as it goes in your favor than if it remains in a narrow range simply because more paper profits are at stake. It usually takes more confidence to sit in a winning trade than to enter it. So how does one achieve the level of confidence needed to sit through good trades? Often it's not the loss of the paper profits per se that are the real threat for traders. After all, if a trade moves your way and you prudently raise your stop-loss level to break even, you'll never get hurt by a sudden, unusual adverse excursion. As disappointing as it may be to lose a paper profit, it's hardly, in itself, a threat to one's account. Rather, the threat to traders lies in how they would process such a retracement. In many cases, their attitude would become quite negative in the face of lost profits. They might criticize themselves for the missed opportunity or lapse into an uncomfortable state of frustration. Instead of viewing the reversal of a gain as nothing lost, simply a scratched trade, they treat it as a situation calling for blame. It's the self-blame and the discomfort of second-guessing that traders are avoiding, not the paper dollar loss itself. "You're never wrong taking a profit" is an attitude that speaks more to this psychological reality than to the logical necessity of taking larger winners than losers. Traders often think they're managing a trade when they exit prematurely, when in fact they're managing their thoughts and feelings about that trade. A large part of confidence is trust. You have confidence in your marriage because you trust your spouse. You have confidence in your driving because you trust your ability to maneuver the car under changing road conditions. If you don't act on your trade ideas, that is, by not seeing them through to their planned conclusion, you actually undercut your confidence by never allowing yourself to develop trust in those ideas. Just as mistrust of a spouse cannot lead to security in a marriage, a failure to trust your time-tested ideas cannot bring confidence to your trading. You can only endure the uncertainty of the trade that moves in your favor by seeing, in your own experience, that the discomfort is indeed endurable, and that you gain far more than you lose by sticking with your planned trades. As your own trading coach, it's important that you instill both trust and confidence in your trading. This can be accomplished in two ways. Instill the confident mindset. Before trading starts, you want to mentally rehearse how you would talk to yourself in the event that you have to scratch a trade after having a paper profit. Specifically, you would rehearse a mindset of nothing ventured, nothing gained. It's okay to scratch a smaller percentage of trades if that allows you to let a larger percentage run, rather than a self-blaming, frustrated mindset. Prepare yourself in advance for adverse excursions so you remove much of their threat value. Build on small change. A useful brief therapy principle is to start making large changes by just starting with small changes. If you do just a little of the right thing, you will provide the feedback and encouragement necessary to expand those efforts. In the case of trading, this is easy. Even if you take much of your position off ahead of a planned target, leave a small piece of the position on to either hit the target or scratch out. This preserves profits and assuages risk aversion, while it enables you to have the first-hand experience of seeing your ideas through to their conclusion. Over time, you can leave on larger pieces and build performance that way. Confidence is not just a function of how you think, but also how you act. If you act in a way to trust your judgment, you'll have the opportunity to see your judgment work out, and that will build confidence. The stop-profit scenario, unfortunately, is a stop-confidence one as well. If you act with confidence, even in small measure, you coach yourself to self-trust and a deeper internalization of that confidence. Coaching cue. The flip side of the impulsive trader is the perfectionist. I've seen many traders come up with great trade ideas only to never participate in them because the market never came to their desired entry levels. Coming up with a big, winning idea and then seeing it work out without you on board can be supremely frustrating. Don't let the perfect become the enemy of the good. If you have a fantastic idea, for instance, you see a market break out and enter a trending mode, get on board with at least a small piece of your maximum position size. If it's a good trend, you can always add to the position later on counter-trend moves. If it's not a good trend, you can exit with a modest loss. But always try to let your trading positions express your convictions. You always benefit psychologically when you act on your confidence. Lesson 30. Coping. Turn stress into well-being. We have seen that stress does not need to become distress if it is balanced with generous amounts of well-being. People can endure high levels of challenge, pressure, and uncertainty if their work is meaningful to them and they experience rewards tied to their efforts. We can think of coping as a set of strategies for handling stressful situations so that they don't become distressful. By coping effectively with the risks and uncertainties of markets and the demands of the learning curve, traders can go a long way toward maintaining a favorable emotional balance. Psychological research tells us that there is no single most effective coping strategy. Rather, people with different personalities and needs employ different coping patterns to best handle situations. When you are your own trading coach, it is important to know how you cope best with trading stresses so that you can activate these strategies on demand. This knowledge is especially crucial because, at times of greatest stress, we often lapse into old, well-worn coping patterns that may have worked at one time but may not be appropriate to the current situation. An avoidant coping pattern may have worked in past work situations involving interpersonal conflict but would be disastrous if employed in the middle of a losing trade in a fast-moving market. Doing what comes naturally is not necessarily the best strategy for handling stress. As we will see in Chapter 5, those past, overlearned modes of coping are often what keep us locked into cyclical problem patterns. One example that I commonly encounter involves traders who utilize highly confrontive coping strategies. Many traders have aggressive personalities and succeed by facing challenges head-on. This can work quite well in situations where one must negotiate a business deal or handle a piece of bad news. In the markets, however, the aggressive response is not always the best one. When facing a series of losing trades, something that happens to all of us, traders can become more aggressive and confront the situation by trading more and larger. This way of handling frustration leads a trader to take maximum risk when he is seeing the market least clearly, a virtual formula for catastrophic drawdowns. You can often recognize failed coping strategies when you look back on your actions and wonder what could possibly have led you to behave that way. So how can you know which coping strategies work best for you in particular situations? What follows is a checklist that will help you sort out your different ways of handling trading problems. For this lesson's exercise, I'd like you to think back to several situations in which you've handled trading problems effectively and several situations in which you've handled them poorly. Next to each coping strategy, place a check mark if it's a mode of coping that you utilized when trading well. Then, next to each item on the list, place a circle if it's a mode of coping that you utilized when trading poorly. Here we go. 1. I reached out to others for ideas or feedback. 2. I took steps to make sure I didn't overreact. 3. I stepped back from the situation and figured out what to do next. 4. I tried to not make a big deal out of the problem. 5. I looked for what I could take away from the situation that would help me in the future. 6. I made a concerted effort to tackle the problem there and then. 7. I recognized my mistake and took action. 8. I decided to stop trading for a while and regain perspective. Once again, the key is not to figure out the right and wrong coping strategies, but rather the ones that have worked best for you, and the ones that have been associated with problem patterns in your trading. One important dimension of coping is action and reflection. Some people benefit most by taking prompt action to own and address challenges. Others step back, get themselves under control, put things in perspective, think through plans, and/or consult with others. Another key dimension is problem-focused versus emotion-focused coping. Some traders respond best to situations by first venting and getting things off their chest, reaching out to others for input and support, and working actively to dampen negative emotions. Other traders fare best by putting feelings aside, analyzing situations, and engaging in active problem-solving to address problems. Often, traders run into problems when they fail to enact their best coping strategies. The analytical trader can get hurt when he finds himself venting emotion and confronting problems without prior reflection and planning. The trader who thrives on social support and feedback from others is unlikely to cope effectively if she becomes discouraged and isolates herself from valued peers. If you contrast your best and worst coping, the times when you've handled trading problems most and least effectively, You identify what you need to do to sustain a favorable balance between well-being and distress. When you track how you cope when you are trading well, you create a mental model of your best ways of handling trading challenges. This model can then become a script that you can draw on during times of difficulty. Make a coping checklist a part of your daily journal. It will alert you to behavior patterns that you can build on for the next market challenge. Coaching cue. Think of your best and worst coping patterns as being sequences of actions, not just isolated strategies. Thus, for instance, when I'm coping well, I first take steps to calm myself and get focused. Then I engage in concrete problem solving. I best cope with losses by analyzing them to death, figuring out what went wrong, and then drawing positive learning lessons from those. When I'm coping poorly, I don't calm myself and blame myself instead, adding a second bad trade to the first as a way of making up for the loss. In my poor coping mode, I don't analyze my losers, instead turning my attention to more promising markets, instruments, or setups. That ensures that I'll learn nothing from my loss, and that my error will repeat itself at some juncture. Think of coping as sequences of behaviors, so we can develop mental blueprints for the actions we need to take in the most challenging market conditions. This helps ensure that trading stress does not generate performance-robbing distress. Resources. The Become Your Own Trading Coach blog is the primary supplemental resource for this book. You can find links and additional posts on the topic of stress and distress at the homepage on the blog for Chapter 3. BecomeYourOwnTradingCoach.blogspot.com/08/daily-trading-coach-chapter-3-links.html. One of the early texts summarizing research into positive psychology is Well-Being, The Foundations of Hedonic Psychology, edited by Daniel Kahneman, Ed Diener, and Norbert Schwartz, and published by the Russell Sage Foundation, 1999. Another worthwhile reference work is The Handbook of Positive Psychology, edited by C.R. Snyder and Shane J. Lopez, and published by Oxford University Press, 2003, and, by those same authors, Positive Psychology, The Scientific and Practical Explorations of Human Strengths, Sage Publications, 2006. How our emotions affect our health and well-being is the topic of James W. Pennebaker's edited text, Emotions, Disclosure, and Health, published by the American Psychological Association, 1995. A number of free articles covering topics of stress, coping, and emotions in trading can be found in the section Articles on Trading Psychology at www.brettsteinbarger.com/articles.htm. Chapter 4. Steps Toward Self-Improvement, the Coaching Process. Success does not consist in never making mistakes, but in never making the same one a second time. George Bernard Shaw. What are the core processes of self-coaching? What concrete steps can we take to make changes in our trading to improve performance? These are some of the topics we'll tackle in this chapter. Much of this chapter comes from research over the past several decades that has illuminated common effective ingredients across all counseling and therapy approaches. An interesting finding from that research is that all of the major approaches to counseling appear to be more effective than no counseling at all. But no single approach consistently shows better results across a range of people and problems. Not only do the major modes of helping seem to work equivalently, they also seem to work for many of the same reasons. Those reasons capture the essence of what creates change and what can fuel our efforts to become our own trading coaches. Lesson 31. Self-monitor by keeping a trading journal. Self-monitoring refers to methods that you use to track your own patterns of thought, feeling, and behavior over time. Self-monitoring is the foundation for many of the other self-coaching techniques described in this chapter because it tells us what we need to change. We can't alter a pattern if we're not aware of its existence. Very often in brief therapy, the first homework exercises involve self-monitoring. Just as observing market patterns precede our ability to trade them, becoming aware of our own patterns is the first step in changing them. One of the most common ways to monitor oneself is through the use of trading journals. Active intraday traders might make entries during a midday break and at the end of the trading day. Others might simply write in the journal at the end of each day in which they are making trading decisions. The key is to catch your patterns as soon after they occur as possible, rather than rely on fallible memory. Note that self-monitoring is not a change technique in itself, but it often leads to changes. Once you see your patterns with crystal clarity, including their costly consequences, it becomes much easier to interrupt them and prevent their future occurrence. At other times, self-monitoring may alert you to patterns that you didn't know were present. This is exceedingly valuable as it lays the groundwork for change that otherwise would have been impossible. Anytime you systematically review your performance over time and the factors associated with successful and unsuccessful performance, you're engaging in self-monitoring. For example, I reviewed my recent trading results trade by trade and found that I was taking larger point losers on small trades than on my larger ones. This review led to the realization that when trades were quite small, I was not as vigilant in setting and sticking to stop-loss levels. Although the total dollar loss for each small trade was not huge, over time the small losses added up. This led me to establish a new routine for setting and sticking to stop-losses with small trades by explicitly writing out my risk-reward ratio for each trade before I placed the order. The self-monitoring made me more conscious of what I was doing, which in turn kept me trading well. Self-monitoring is the foundation on which all coaching efforts are built. My experience is that the best predictor of failure in the trading profession is the inability to sustain self-monitoring. This inability leaves traders unable to clearly identify their problem patterns, and it prevents them from reflecting and learning from their efforts at change. Goals without self-monitoring are but mere good intentions. They never translate into concrete actions to initiate and sustain change. Why would a trader, seemingly desirous of success, not sustain efforts to monitor her own thoughts, emotions, and/or trading performance? I believe it's because many traders are motivated by trading and making money, not by a desire to understand themselves and markets. This is an important distinction. To paraphrase Coach Bob Knight, they are motivated to win, but not motivated to do the work it takes to become a winner. In the best traders, self-mastery is a core motivation. It's why they continue trading long after they could have comfortably retired. The most common format for beginning a regimen of self-monitoring is keeping a journal. The basic components of a self-monitoring journal might look as follows. Divide your journal page into 3 columns. The first column describes the trade that was placed, including the trade size and the time of day. If you scale into a single position, you would treat that as a single entry in the journal. Similarly, if you enter several positions to capitalize on a single trade idea, e.g. you want to be long precious metals, so you buy 3 different mining stocks, those would also be incorporated within a single journal entry. The first column might thus summarize what you did for each trade idea, how much you risked on the idea, when you placed the trades, the prices that you paid, and how you placed the trades, e.g. all at once or by scaling in, executed at the market or with limit orders. If you are a high-frequency trader, consider the possibility of automating your trade monitoring with tools such as StockTicker, www.stockticker.com, or TraderDNA, www.traderdna.com. The second column would summarize the outcomes of the trades, including the prices and times of your exits, your P&L for that trade or trade idea, and how you exited the trades, e.g. all at once or scaling out at the market or by working orders. The third column would include all of your behavioral observations for that particular trade or trade idea, what you were thinking, how you were feeling, your preparation for that trade, your degree of confidence in the trade, etc. In other words, the third column takes a look at you and your state of mind, thought patterns, and physical state during the trades. The third column could also include observations about how well you entered, managed, and exited the trades. Whatever stands out for you, good or bad, about the trade would be included in that third column. Keep your trading journal doable. Many efforts at self-monitoring fail because they become onerous. For a trader such as myself, who only place at most a few trades per day, such a journal is relatively easy to keep. Prop traders who make dozens of trades per day or more, however, are likely to find such a journal to be onerous. One of the best ways to sabotage self-monitoring efforts is to make them so burdensome that you won't sustain the effort. If you're an active trader and cannot automate your monitoring of trades, you can streamline the journal in one of several ways. You can create a single entry for the morning trading and a second entry for the afternoon's trading, with the columns simply summarizing your positions, your P&L for the AM or PM, and your associated observations of your trading at those times. You can create entries for selected positions only that stand out in your mind, either because they were quite successful or quite unsuccessful. If you sample from your trades in this manner, make sure that you include best and worst trades so that you can observe positive and negative patterns. These are the trades from which we learn the most. If your trading is complex, with many positions, hedges, and a flowing in and out of risk exposure over time, like a market maker or a very active portfolio manager, you can simply summarize your day with a single journal entry. The first column would review your major trading ideas, the second column would note P&L, and the third column would include your self-observations. There is no single self-monitoring format perfect for all traders. The key is to adapt the format to your needs and trading style. The real work comes when you've accumulated enough entries to notice patterns in your trading, the factors that distinguish your best trades and days, and those that accompany your worst trading. How to analyze your self-monitoring journal will be the focus of the next lesson. For now, however, your task is simply to sustain self-awareness, to be an active observer of your own trading process. When you are your own trading coach, there is always a part of you that stands apart from your decision-making and execution, observing yourself and exercising control over what you do and how you do it. The real value of the trading journal is that it structures the process of self-awareness and helps make it more regular and automatic. If you were walking on a familiar street, you would hardly think about how you walk. Everything would be on autopilot. If, however, you were taking the same walk in a minefield, you would be exquisitely self-aware, conscious of every step that you took. Trading is neither a walk in the park nor a minefield. Perhaps it's more like a walk in a beautiful but somewhat dangerous park. You want to be absorbed in the walk, but alert and aware at the same time. That is the function of the trading journal. It enables you to monitor yourself, even as you are immersed in what you're doing. Coaching Cue. A great insight into journal keeping is offered by Charles Kirk, www.thekirkreport.com, in Chapter 9, who enters his observations into a database program so that he can readily retrieve journal entries on various topics. This is an effective way of monitoring specific trading challenges over time. Lesson 32. Recognize your patterns. One of the keys to brief therapy is the creation of a concrete focus for change. One of the reasons that older forms of therapy took so long to implement, including years of psychoanalysis, was that they attempted broad personality changes. Our understanding of personality traits and their biological, hereditary components helps us to be a bit more modest in our aims. No form of coaching or counseling will restructure a person's personality, nor should it. The goal of coaching is to help people work around their weaknesses and build their strengths, so that they can express their basic personalities and skills as constructively and successfully as possible. You cannot change your personality, but you can change how it is expressed. Many self-described coaches lack formal training in psychology and especially lack the experience and grounding of licensed helping professionals. They acquire a cluster of self-help methods and try to fit all problems to those. The result is a canned set of solutions for any given problem. This can be disastrous. The patterns that interfere with trading often lie well outside canned self-help nostrums. One successful trader I recently met at a conference presentation was having a poor trading year and was even considering retiring. She complained of a loss of enthusiasm and excitement about her trading, as well as weight gain and more negative feelings about herself. She had seen 3 prior coaches and therapists, all to no avail. After a short discussion, I obtained enough information to suggest that she obtain a blood workup from her primary care physician. She did so, and the results suggested a low level of thyroid activity. Once she received proper hormonal supplementation, her mood and energy level returned, her concentration improved, and she resumed her successful career. How many traders lose their careers because they never understand the patterns that underlie their problems? You might ask the question, how can I, as a trader, relatively uneducated in applied psychology, ever hope to identify obscure patterns such as low hormone levels? If experienced coaches and counselors miss the pattern, how can I detect it? Ironically, I think that you're in better shape than most commercial coaches to identify and act upon unusual patterns that interfere with good trading. I could readily make the recommendation for the trader because I was not seeking her business. She was not paying me for my services, and I did not stand to gain by making one recommendation versus another. Note, my coaching is limited to a limited group of proprietary trading firms, hedge funds, and investment banks. I don't take on individual traders as clients. Most coaches who focus on retail traders, on the other hand, need to constantly drum up business. It is not in their self-interest to raise a possible course of action, such as blood tests and thyroid medication, that doesn't lead to further services and additional fees. As a result, they focus on solutions that they can provide, i.e., that will bring them additional business. When all you have is a hammer, Maslow once remarked, you tend to treat everything as nails. As your own trading coach, you have no such conflicts of interest. You can learn pattern recognition for yourself and diagnose your own concerns. If the problem still eludes you, even after you've reviewed your journal extensively, send an email to the special address reserved for this book, coachingself@aol.com, see the conclusion, and I will do my best to point you in a promising direction. But I think you'll be pleasantly surprised to find how readily you can tackle your own challenges once you learn a few basic techniques. Once you learn to coach yourself, you have the skills to guide your development across a lifetime. So let's see how you can become expert in recognizing your own patterns, building on the trading journal described in the previous lesson. Reviewing your journal entries, you want to divide them into two clusters, those describing your most successful trading and those that capture when you were trading at your worst. The first cluster will reveal what we call solution patterns. The second cluster alerts you to problem patterns. Many times, the difference between the solution and problem patterns will themselves point you to practical actions you can take to improve your performance. For instance, you might notice that during your successful trading, you're more patient entering trades and take fewer trades, each with smaller size. When you're less successful, you trade more often and with maximum size. The comparison between best and worst trading will also alert you to differences in your coping with market challenges. You may find, for example, that when you're trading well, you tend to be very problem-focused. When you are less successful, you trade while you are confused or frustrated, without waiting for clearly defined opportunity. The key is to look for patterns, not just isolated instances of good or poor trading. For each good day of trading, you might jot down several things you did right, and then see which entries appeared day after day. Similarly, in reviewing the poor trading days, you would write down the key mistakes you made and observe which ones appear over time. Your trading strengths can be found in the patterns that repeat across successful trades. If you cannot find patterns that stand out, you may need to monitor your trading over a longer period so that you have a rich sample of good and poor trading days. You are looking for common elements that jump out at you. Don't be too quick to read subtleties into the patterns. The best things to work on are the ones that are most salient, that hit you between the eyes. For instance, when I have done the pattern recognition work and compared my best and worst trading, I found stark differences in the sizing of my trades. Initial positions neither too large nor too small performed best. The timing of the trades, positions too early in the morning or later in the afternoon, underperformed those made after the market sorted itself out in the first minutes of trade. And the duration of my trades, better performance when held shorter with clear targets and stops. I also found that I traded best when I had a clear, longer-term picture of the market to guide shorter-term entries and trades. My absolute worst trading occurred when I held a strong view at the start of the market day and did not modify the view as the day progressed, continuing to trade against a market trend. Notice how each of these patterns focuses a trader on what to change, which is the first step in deciding how to make changes. Many times, traders fail to make changes because they aren't clear on what to change. They rely on vague generalizations, "I need to be more disciplined," rather than identify specific behaviors to work on. By conducting detailed comparisons between your best and worst trading, you can find a focus for your self-coaching efforts and channel your energies in the most constructive directions. If you know your patterns, those that bring you success and failure, you're generally halfway home in making lasting changes. Below are some patterns to be especially aware of as you review your journal. Emotional patterns. Distinct differences in how you feel when you're trading well and when you're trading poorly, particularly before and during trades. Behavioral patterns. Notable differences in how you prepare for trades and manage them during your best and worst trading episodes. Cognitive patterns. Meaningful differences in your thought processes and concentration level during and after your best and worst trades. Physical patterns. Differences in how you are feeling, your energy level, physical tension and relaxation, and posture when you're trading at your best and worst. Trading patterns. Differences in the sizing of trades, times of day when you're trading, mode of entering and exiting trades, and instruments being traded as a function of good versus poor trading. Coaching cue. Many times you'll observe more than one kind of pattern, and many times those patterns will be linked. For example, your cognitive patterns may lead to particular emotional patterns, which are then linked to specific trading patterns. Think of patterns in sequence, as a kind of positive or negative cascade, not as either-or phenomena. Excellent coaches see not only patterns, but also patterns of patterns. Here are some of the most common patterns among traders to watch out for. Placing impulsive, frustrated trades after losing ones. Becoming risk-averse and failing to take good trades after a losing period. Becoming overconfident during a winning period and taking more marginal and/or unplanned trades. Becoming anxious about performance and cutting winning trades short. Oversizing trades to make up for prior losses. Ignoring stop-loss levels to avoid taking losses. Working on your trading when you're losing money, but not when you're making money. Becoming caught up in the market action from moment to moment rather than actively managing a trade, preparing for a next trade, or managing a portfolio. Beating yourself up after losing trades and losing your motivation for trading. Trading for excitement and activity rather than to make money. Taking trades because you're afraid of missing a market move rather than because of a favorable risk-reward profile for your idea. Lesson 33. Establish costs and benefits to patterns. A huge step forward for traders who seek to mentor themselves is to know the patterns of behavior, thought, and emotion associated with successful and unsuccessful trading. Still, it is necessary but not sufficient to produce lasting change. This is because knowing a pattern is different from having and sustaining the motivation to alter that pattern. It is in the motivational arena that many of our change efforts, personal and professional, fall short. We need only to look at the dismal record of people's attempts to diet, eat in healthy ways, or exercise regularly to see that knowing what you need to do and actually doing it are two different things. When you are your own trading coach, your challenge is to motivate change, just as a sports coach motivates a team to keep them working hard and sustaining practice efforts. If keeping a journal and tracking your patterns of good and bad trading is nothing more than a routine exercise, another item on a to-do list, it will not inspire motivation, and you will not sustain the efforts. Stoking the desire to make changes is difficult, especially when trading is going reasonably well. If it ain't broke, don't fix it, is a formula for eventually lacking fixes when things do break. But there's a more important reason for sustaining self-coaching efforts. When you're trading well is precisely the time you want to be the most self-aware of your strengths, so that you can maximize your earnings at those times. The true competitors and most successful participants in sport, warfare, and games of skill such as chess are the ones who possess the killer instinct. They have a sense for when they have the advantage, and they press that advantage to the hilt. Making modest money when you are trading well is a great way to ensure poor returns when you're not seeing markets as well. For many traders, it's the relatively few, large gains from the best trading periods that contribute most to overall profitability. The measure of self-coaching is how hard you work on trading when you're making money. It's as important to work on yourself when you're trading well as when you're trading poorly. It's not that you want to fix what isn't broken, rather you want to crystallize what you're doing right so that you can do more of it and capitalize fully on it. Conversely, when you're trading poorly, you don't want to lapse into discouragement and defeat. Maintain the journal and the pattern recognition efforts to keep you in a constructive mode. even when all you may be able to do for the moment is to cut your risk when your negative patterns surface. That is still progress. So how do excellent traders and competitors in any field sustain the motivation to operate at elite levels of performance? An important driver of that motivation is an intense competitive drive and a ferocious desire to win. The traders I've worked with personally who have been consistent high earners have traded quite differently and viewed markets in radically different ways. Some traders have been loud and outgoing, others have been cerebral. Some have been uncannily intuitive, others have been analytically insightful. The common feature among all of them, however, has been their intense competitive nature. They compete against peers, they compete against markets, most of all, they compete against themselves. They derive pride and validation not just from making money, but also from getting better, which is what keeps successful traders in the game long after they could have retired comfortably. The lesser traders, they trade to not lose. They trade to keep their jobs. They don't hunger to become more than they are. They want to do well, not to be their best. The drive for self-improvement is different from the desire to make money and is far more rare. These successful traders can sustain their drive by staying mindful of the costs of their negative patterns and the benefits of their positive ones. When a successful trader decides to avoid a particular trade or market, it's often because of a specific recollection that this idea has caused past losses. By staying emotionally connected to the pain created by their worst trading, traders stoke their motivation to avoid trading mistakes. Similarly, knowing their strengths is not just an abstract awareness for successful traders, but an emotional connection to the pride and sense of accomplishment over doing well. A best practice in self-coaching and a great assignment for this lesson is to not only summarize the patterns of your best and worst trading, but to actually write down and visualize the costs associated with the most negative trading patterns and the benefits that accompany the best patterns. In other words, you don't finish your journaling until you achieve a state in which you are emotionally connected to the things you are writing about. You will want to change your negative patterns when you get to the point of hating those patterns and becoming disgusted with the ways in which they've set you back. You'll want to build on your positive patterns when you see and feel their benefits. When you're coaching yourself well, journaling is an emotional exercise, not merely a cognitive one. There is little to be gained from abstract positive thinking. Reciting such affirmations as, "I will be a successful trader," is empty at best, self-delusional at worst. The reason such positive thinking doesn't work is that it is not connected to the day-to-day conduct of your trading. It's not enough to simply make yourself feel good, and indeed there can be real value in feeling so bad that you'll never repeat a mistake again. What is helpful is to associate the best emotional experiences of trading, your greatest moments of joy and achievement, with the specific practices that brought you such happiness. It is also tremendously helpful to recreate the pain of your worst trading with concrete vows to never go there again. Think of football, basketball, and tennis coaches. Every practice session teaches skills, offers feedback, and supplies motivation. It's not a bad formula for self-coaching as well. You are most likely to change a negative thought or behavior pattern when you associate it with concrete costs and consequences. You're most likely to motivate a positive behavior by attaching it to specific, felt benefits. Coaching cue. Efforts at self-change break down when people start to make exceptions and allow themselves to revert to old ways. To accept exceptions, you have to accept the old negative patterns. It's when our old patterns become thoroughly unacceptable that we are most likely to sustain change. When you keep a journal, you want to cultivate an attitude, not just jot down bloodless summaries of what you do. If you don't see plenty of emotion words in your journal, constructively expressed, the odds are that your journal will summarize your changes but not motivate them. Lesson 34. Set effective goals. Successful coaching requires a focus for change. Many self-help efforts among traders fail because they are unfocused. One day the trader writes in a journal about position sizing and works on that. The next day he emphasizes emotional control, and the following day he stresses taking losses quicker. By jumping from one focus to another, no single direction is sustained. This is problematic because most learning does not occur all at once. We know from research that learning typically requires many trials and considerable feedback. If we think about important skills that we've learned, from using a computer to driving a car, we can see that trial and error has been the norm. I can study a map of a new city for a long time and learn quite a bit, but I ultimately only learn to find my way around by driving on various roads, following signs, getting lost, and recognizing landmarks. If we pursue this learning intentionally, organizing our trials over a concentrated period of time with immediate feedback throughout, we can greatly shorten our learning curves. It's easier to learn to play a piano by practicing every day and taking lessons every week than by engaging in occasional efforts spread over years. The training of an Olympic athlete is a study in proper skill development, intensive work on specific aspects of performance, accompanied by plenty of coaching feedback and corrective efforts. When we lack a specific focus for change and jump from one trading goal to another from day to day, we don't really enter a learning curve. There is nothing cumulative in our efforts. As your own coach, you need to establish, and also sustain, a specific direction to guide your growth and development. This is the key to effective goal setting. If motivation provides the energy for self-improvement, goals supply the aim, the channeling of that energy. When you recognize a problem pattern, it is not the same as establishing a goal for self-work, though the former usually will guide the latter. A problem pattern alerts you to what you're doing wrong. Goal setting requires an awareness of new patterns of thought, feeling, and/or action that will replace the problem pattern. A goal states what you are going to do or not do in specific situations. If you have constructed your trading journal and pattern identification exercises in the ways suggested in recent lessons, many of your goals will naturally follow from the patterns associated with your best trading. Your overarching goal will be to trade in the way that you typically trade when you're trading well. Notice that I am defining goals in a process sense, rather than as absolute outcomes. This is very important. Many traders think of such goals as making $1 million or being able to trade for a living. These outcome goals may be motivating and definitely have their place, but they do not focus a trader on what she needs to do today and tomorrow to become better. Traders on a short time frame do not have full control over their outcomes. A trader can make good decisions, placing all odds in their favor, only to lose money when markets behave in an anomalous fashion. What traders can control is the process of trading, how they make and implement decisions. The most effective daily goals emphasize trading well, not making oodles of money. The same logic guides athletic coaches. A coach may stress the goal of victory over the next opponent, but the day-to-day practices will emphasize such fundamentals as swinging at good pitches, baseball, making the extra pass, basketball, and blocking effectively on running plays, football. These process goals provide the ongoing focus for practice over time and ensure that coaching leads to effective learning. Every coach is, at root, a teacher. When you're your own coach, you guide your own learning efforts. Effective goals target effective trading practices that break trading down to component skills and then set targets for these one at a time. As you examine your journal entries for the patterns that distinguish your best and worst trading, the question you want to ask is, what is the difference that will make the greatest difference in my trading? Stated otherwise, your question is, what are the 1 or 2 ways I can trade more like my best trading and less like my worst trading? The answer to these questions will form the basis for your best process goals and will guide your self-development efforts from day to day and week to week. Goals should not be so specific that they only apply to a limited set of circumstances. I want to be a market buyer when put-call ratios hit 100-day highs. And they should not be so broad or vague that they don't guide concrete actions. I want to trade less often. The best goals are ones you can work on every day for a number of weeks. If you do not work on a goal day after day for at least several weeks, it's unlikely that you will turn your new patterns into positive habits. As mentioned earlier, you don't want to focus on too many goals at once. I've generally found 3 to be as many as I can work on with consistent intensity, and many times I will focus on fewer objectives. This means that a good self-coach will prioritize needed changes, emphasizing those differences that will most make a difference. A great exercise to try is to close your eyes and imagine yourself as a great trader. Visualize yourself as the best trader you can possibly be, or maybe visualize an absolutely perfect trading day. What are you doing differently from your usual trading when you're the great trader? How is your trading different on the perfect day than on a poor one? In your visualizations, try seeing yourself doing all the right things when you're trading well. What are you doing? How are you doing it? Those visions, made highly specific, will form the backbones of your goals. Coaching cue. Make it a point to get to know successful traders who have had plenty of market experience. Many times you can form effective goals by simply trying to emulate their best trading qualities. Lesson 35. Build on your best. Maintain a solution focus. To this point, the lessons in this chapter have emphasized the importance of tracking the patterns associated with both your trading shortcomings and your trading successes. It is common to focus on the former only. When we use coaching to build strengths, rather than simply shoring up weaknesses, that solution focus produces surprising, and surprisingly rapid, results. For more on the solution-focused approach to change, check out The Psychology of Trading. There are several reasons why a solution focus is helpful for traders who seek to coach themselves. Motivation. It is easier to stay motivated and optimistic when we emphasize what we're doing right, not just where we fall short. Imagine a sports coach who only harped on players' weaknesses. Over time, that would be demoralizing. When the focus is strengths, coaching can be empowering and inspiring without ignoring changes that need to be made or the urgency of making those changes. Goal setting. Knowing what you've done wrong in and of itself does not tell you what you need to do right. When you focus on your best trading, you can identify specific patterns that are associated with your success and turn these into concrete goals for future work. Bang for the buck. Working solely on improving weak areas is unlikely to create strengths. At best, you'll take a deficient area and bring it to average. It's making the most of strengths and learning how to work around shortcomings that produces optimal performance results. One of the reasons I emphasize the importance of paper simulation trading and playing with different trading styles and markets is that this experience enables you to observe your own strengths firsthand. Many times, traders stumble across their performance niches when they discover something they're good at. If you don't know your strengths, it's unlikely that you'll be able to systematically build on them and turn them into drivers of elite performance. But you might wonder, how do I stay solution-focused if day after day I'm in a slump and losing money? It is difficult to stay connected to our strengths when our failings are written all over our P&L summaries. We've seen that this question is a particular challenge when we identify winning days as good trading and losing days as bad trading. This thinking makes it difficult to observe and appreciate good trading when we're not making money. But traders can trade well. They can take setups with demonstrated edges, size positions well, and manage the risk of their trades, even if trades happen to go against them. After all, even a 60-40 edge per trade ensures that a trader, over time, will have sequences of consecutive losing trades and/or days. If you define good and bad trading in terms of process, not just outcome, you can observe strengths during performance slumps, and also you can detect flaws even when you're making money. To keep yourself solution-focused, you want to ask yourself, what did I do well today? What about this trade did I do right? You'll find that over time, your performance is varied. Not all trades are poorly conceived, poorly executed losers. If you lost less today than the past several days, what did you do better? If you had a number of winning trades during several losing days, what distinguished those winners? Focus on the improvements in your trading and then isolate the specific actions you took to generate those improvements. These actions can be meaningful additions to a daily to-do list. What did I do better this week than last week is a great starting point for guiding next week's efforts. Do more of what works. It's the essence of the solution focus. Another technique for sustaining the solution focus, referenced at the end of the last lesson, is to identify a mentor or trader you respect and ask yourself how he would be trading a particular idea. Sometimes it is very helpful to try out solution patterns that you borrow from others. Over time, you adapt these patterns to your own ways of thinking and trading so that they become distinctly yours. For example, I've worked with quite a few hedge fund portfolio managers and have learned from them the importance of thinking thematically about markets, observing various sectors and asset classes, and creating narratives that guide a longer-term perspective. The specific themes I track and the timeframes I monitor are completely different from theirs, but there is a similarity of process. When I'm not trading well, I can model their processes and place myself more in line with market's trends. Still another way to keep the solution focus is to make special note of mistakes that you don't make in your trading. These notes represent exceptions to problem patterns. If there's a mistake you've made lately, it helps to hone in on occasions when you have trouble. This is one of the most promising facets of self-coaching. By discovering who you are at your best, you can create goals that are specific, unique, and relevant to you. The learning, as a result, will be more relevant and empowering, reinforcing strengths as you build them. A great assignment is to review your trading journal and assess the ratio of problem entries, writings about your bad trading, to solution entries, writings about what you're doing best. If the ratio is lopsided in favor of the problem focus, consider structuring your writing to force yourself to address a few basic questions. What specifically am I doing best in my recent trading? How specifically am I avoiding old trading mistakes when I'm trading well? How specifically am I trading like my idea of the ideal trader during my best trading? A good sports coach never loses sight of a player's potential, even when correcting weaknesses. The challenge of self-coaching is never losing sight of your strengths, and then working daily on how you can maximize them. Coaching cue. We have solution markets as well as solution patterns of behavior, specific markets and market conditions that facilitate our most successful trading. Knowing these intimately is very helpful in allocating risk to your trade ideas. It can also be helpful in staying out of certain kinds of trades and emphasizing others. Lesson 36. Disrupt old problem patterns. As you continue your journaling over a period of weeks or longer, you will become attuned to your problem patterns. Usually, a trader does not have 10 different problems. Rather, he may have 1 or 2 problems that manifest themselves in 10 different ways. For instance, a trader may grapple with missing good trades, occasionally ignoring stop-loss levels, sizing positions too conservatively, and cutting winning trades too quickly. These examples may seem like different problems, each requiring a different coaching plan and process. As the trader examines his or her journals, however, they're likely to find that a single problem pattern, anxiety related to negative self-talk, is responsible for all of these. It's not that the trader has many problems, though it may certainly feel that way. It's that there is a single core problem that affects many aspects of the trading process. As you can see from the above example, self-coaching requires that you not only detect patterns, but patterns among the patterns. It's these patterns of patterns that usually form the core focus of coaching efforts. This means that if you can accurately identify the core pattern, many different trading difficulties can fall into place in a reasonable period of time. Once the trader in our example learns to master anxiety and not channel it through self-defeating self-talk, he will miss far fewer opportunities, become more consistent in sticking to stop-loss levels, take appropriate risk, and let trades progress toward their designated targets. Asking yourself, what is the common denominator behind my different trading mistakes, begins the process of finding patterns of patterns. Often the core pattern will involve a feeling state that recurs for the trader and that disrupts good decision-making. For example, the trader may lapse into periods of anxiety, frustration, or self-defeat. How this feeling state impacts trading may vary from day to day, which is what produces the multiple manifestations that lead traders to think that they have dozens of problems. By tracing each trading problem back to a particular cognitive, thinking, or emotional, feeling state, we can then identify the events that typically trigger that state and design effective coaching interventions to tackle those situations and triggers. Often, a trader will know what he is doing wrong, but won't know the right thing to do. This issue occurs when traders have not been sufficiently solution-focused. They know, for instance, that they should not double down on losing trades to make money back, but they don't know how to re-enter a trade and exploit good research after having been stopped out of an initial position. This situation requires two important coaching steps. 1. Interrupt the problem pattern so that it does not disrupt trading. And 2. Develop rules and procedures for a possible solution pattern, which will form the theme of the next lesson. Because traders don't always have solutions readily at hand and need to stop bleeding losses, interrupting problem patterns is often a first coaching objective. Above all else, do no harm. The Socratic oath in medicine is relevant here. The ability to stop doing wrong things won't, by itself, generate good things, but it can keep you solvent long enough to find solutions. Change starts when you stop yourself from doing what doesn't work. A major point from the psychology of trading is that the key to disrupting problem patterns is to alter the state that you're in when those problems first appear. This means that it's important to become vigilant to the emergence of patterns, recognizing the characteristic ways that they appear. For example, some of my worst trading occurs when I focus on my P&L as the trade is unfolding. This focus may lead me to tolerate larger than normal losses in a small position because it's not hurting me, or it may lead me to take profits too quickly on a large position to book a sure gain. I've learned that if I start counting profits during the trade, I need to refocus my attention. I accomplish this by turning briefly from the screen, fixing my gaze on something nearby, and taking a few deep breaths. Once I'm in a new state, more calm and focused, I find it easier to be detached from the P&L and let the trade unfold in its planned manner. Another quick way of shifting state is simply to walk away from the screen temporarily and engage in a quick activity unrelated to trading. Some activities might be a few stretches or exercises, talking with a fellow trader, or getting something to eat or drink. Often, doing something different enables you to approach situations differently. The new activity helps you shift your frame of thinking and feeling. I find this activity particularly useful after taking losses. A quick walk outdoors, getting away from markets, allows me to return to the screen with a fresh perspective. When you change your physical state, you alter how you experience the world and process information. Still another mode of state shifting is to write in a journal or talk aloud during a particular situation. The latter is especially useful if you're trading alone and won't be a distraction to others if you process information aloud. If you write or talk about what is happening and give voice to what you think and feel at the time you're thinking and feeling it, you shift from being a person immersed in experience to being a person observing his own experience. If you're an active trader, in and out of markets quickly, you may not have time to write out journal entries and observe yourself in that manner. Talking aloud, however, can be accomplished while still watching the screen. In fact, that's how many traders in Chicago work with me during the trading day. They talk aloud about what is happening while they are engaged in trading. To use my example from above, if I talk aloud my thoughts about my P&L while I'm in a trade, that alerts me to the fact that I'm no longer focused on the trade itself. If I hear myself talk about something other than the management of the present trade, it kicks me into a different mode and pushes me to make an effort to get back to the market itself. This shift becomes easier and easier as traders learn to make self-observation a habit. When you talk aloud your thoughts and feelings, you no longer identify with them. You listen to them as an observer. A good self-coaching question to ask yourself is, how different would your P&L be if you could eliminate the 5% of your largest losing trades? Often this percent by itself would make a huge difference to a trader's profitability. By interrupting the patterns that accompany those large losers that result from bad trading, not just being wrong on an idea, you can, above all else, do no harm. It's usually a particular emotional state or pathway of thinking that triggers the bad trading. If you recognize the state and thoughts as they're occurring, you can stop yourself and, at the very least, avoid disaster. This recognition would make a wonderful goal to work on in your trading. Choose just one negative pattern that has accounted for many of your largest losing trades, and then identify the common triggers for that pattern. Then select one method for interrupting the pattern when you notice one of the triggers occurring, even if that method is doing nothing more than placing no more trades until you regain emotional equilibrium. A good coach knows when to take his player out of the game for rest and a lesson. When you are your own trading coach, sometimes you need to do something similar. Remember, the goal is not to trade, the goal is to make money. Sometimes the best way to make money over the long haul is to ensure that you keep your money when all the wrong patterns are firing. Coaching cue. If I say something in a frustrated tone or make a frustrated gesture while I'm trying to get into a trade, while I'm managing a trade that's already on, or while I'm trying to exit, that is my signal that I need to interrupt an emerging pattern. I typically will slow my breathing considerably and focus on my breathing as I'm continuing with my business. As soon as is practical thereafter, I take a short break from the screen and don't enter any new positions until I have figured out why I'm frustrated, what that tells me about me and/or the market, and how I want to factor that into my trading. If you use frustration as a cue to interrupt patterns, you are prevented from acting mindlessly on the frustration, but also you are set up to become mindful of the reasons for the frustration. Lesson 37. Build your consistency by becoming rule-governed. One of the major goals of coaching yourself is to turn positive trading behaviors into habit patterns. This is crucially important. You don't want to have to think and make yourself do the right things each time opportunity occurs. Rather, you want to do the right things automatically. Effort and energy you spend thinking about what to do and trying to make yourself do it is taken away from markets themselves. When you can do the right things automatically, your concentration can be wholly focused on what you are doing. That is essential if you're going to be sensitive to subtle market shifts in supply and demand. Rules are the bridge between new behavior patterns and acquired habits. Children are not born with a developed sense of ethics and responsibility. They are taught rules by parents and teachers that are eventually internalized. Some of that internalization occurs by observing role models over time. Much of it results from turning the desired behaviors into explicit rules that can be rehearsed. Such mental rehearsal allows people to keep old behavior patterns in check and make conscious efforts to engage in new ones. We see such dynamics at work when traders are learning to control losses. Instead of exiting trades when the pain of loss is too great, a pattern that comes all too naturally, a trader will create a rule-based stop-loss level. The rule may be accompanied by other thoughts that emphasize the importance of the rule, the losses that will follow from not following the rule, and the benefits of adhering to the rule. In such an instance, traders choose to refuse to do what they feel like doing at the moment. Rather, they seek to be rule-governed. That is what keeps us driving on the proper side of the road even when we're in a rush. Rules are checks on our impulses. They keep us doing the right things even when we're not inclined to act in our own best interests or the interests of others. We follow social rules without even thinking about the rules of proper social behavior because we've repeated the right behaviors so often and have internalized the rules so thoroughly over time. That's the goal with trading rules. Trading is especially challenging because the normal human response is rarely the one that makes money. One exercise from the Trader Feed blog examined periods of time that were up on a 1 month, 1 week, and 1 day basis, and compared those with periods that were down over those 3